So my name is Caleb Jennings. I'm a partner with the CAMS Jennings Group of Compass Mortgage. Just a quick little bit about us. If you haven't worked with us before, Compass Mortgage, we're an independent mortgage bank. We underwrite our loans in-house. We fund our loans, which gives us total control of the process, which John and I love. We can go knock on the underwriter's door if we need to, which is awesome. We also have an amazing program that our buyers and our partner agents love, which is our Get Committed program. And what that is that we do a full underwritten loan commitment for our buyers where we can guarantee funding and we can close as quick as 15 days. And this has been helping our buyers in this super competitive market get the edge to win. We just won an offer last night as a result of it, and it was a multi-offer. So if you have questions about that, please hit us up about that after this as well. But today's presentation is going to be about rates, real estate, and the recession. The reality is we're in a recession. I mean, John's going to talk about this, but really we want to be able to help you guide your clients in this process because I'm sure there's a bazillion questions that you get from your clients, and we want to arm you with the facts so that you can help navigate this market right now. So I want to turn it over to my partner, John Cams, who is going to walk us through this. How you doing, Johnny?
Hey, good. Thanks for everybody for coming. Cool. So I'll just go ahead and get right to it. Hopefully
we're all good.
Here. Great. So rates, real estate, and recession. Let's talk a little bit about the dynamics that we got going here. Inflation. So inflation is a big buzzword nowadays. I'm sure you've heard it. Inflation has been running rampant. We are in a period now where rates have gone up very dramatically because of inflation. We also have Fed hikes and balance sheet runoff. Talking a little bit about this, I think it makes sense to talk a little bit about what the Fed has actually been doing. So the Fed, prior to about the beginning of the year, has basically been doing two things. Number one, they've been buying mortgage bonds and treasuries, and they've been doing this as to basically drive interest rates down. So they've been a big buyer of these securities. And not only have they been buying these bonds, but they've also been what they call reinvesting. So in up until just recently, the Fed would basically say, well, if somebody refinances a mortgage, sells a home, pays it off, and now that the loan is paid off that is on the Fed's books, they would take the money and throw it back into the bond market, throw it back into the treasuries or mortgage-backed securities. Well, the Fed now has basically said they're going to stop doing that. They're going to run off their balance sheet. So we'll see what the effects of that has been doing, but it's definitely been sending some turbulence through the market. And then the impending recession, which some people feel we're already in right now. Okay, so let's just go ahead and take a look at history here. So the Fed rate is basically the Fed funds rate. And ironically, as you've seen, they just recently raised this by 0.75%, and I think a quarter of a point. So the ironic thing about this is that you would counterintuitively, when they raise this rate, mortgage rates have fared well and tend to fare well. And the reason being is that when the Fed raises their Fed funds rate, it's primarily to fight inflation. Inflation is the arch enemy of bonds, especially long-term bonds or mortgage rates, because it's a long-term rate of return. When somebody invests in mortgage bonds, it's a fixed rate of return to that investor. So if mortgage rates were 3%, that investor can never yield more than the 3% over the life of the loan. So when costs go up, it erodes the return of the fixed return that a mortgage holder or investor would obtain. The only way to fight that is to have mortgage rates go up. So if you look at history through here, you can see a pattern. You can look at the first one here, this Bolks, Burns, and Volkner in the 70s and early 80s. Inflation went up from 7 to 14%, and you can see right here, inflation goes up, bam, mortgage rates go up. They went from 12 to 18%. Volkner came in after Burns and raised the Fed funds rate when he got in from 11% to 20%. And you can see the response was inflation went down pretty dramatically, went from 14% to 5%. And then you can see mortgage interest rates response, they went from 18% to 12%. and then the consequences was a recession. The S&P lost 30%. Last time we had, right after that, the last inflationary period was with Alan Greenspan, and he saw inflation go from 1.75 to 3.5%, and mortgage rates went from 7 to 8.5% because of inflation going up. So Alan Greenspan came in, raised the Fed funds rate from 4.75 to 6.5, and then you saw inflation come down from 3.5 to 1%. And again, you saw the mortgage rate response. Once inflation came down, rates went from 8.5 to 5.5%, and the S&P lost 50%, and there was a recession. So here's our present time. You have Jerome Powell, who has seen inflation go from 1.5 to 8.5%. And he's actually seen mortgage rates go from 2.5 to, at the time this was made, 5%, where now we're actually, high fives over 6 on a 30-year fixed mortgage. So what he's predicting to do is go from 0% to 3% on this Fed funds rate, and potentially even higher. And inflation should drop. And what we should see, if history is any indicator, is once inflation goes down, the mortgage rate response should be a decline in mortgage rates, and then consequences are inevitable recession. So let's talk a little bit about the hikes and the runoffs and the impacts and rates, because this is definitely something that the Fed has not done, where they basically stopped their quantitative easing, which is basically their fancy term for them buying 10-year treasuries and mortgage bonds, and had a runoff at the same time. So if you look through in 2016, the last time the Fed hiked back then was they raised the Fed funds rate by 1/4 point, and you saw mortgage rates decrease. Then you saw mortgage rates increase, and then they hiked again, and it was a very small response in mortgage rates. They went down, they hiked again, mortgage rates went down. The Fed hikes in July, and you see mortgage rates start to go up. But then you see the last time that they started to do a runoff, where they said, hey, we're not going to keep reinvesting our principal payoffs in treasuries and mortgage bonds. You can see that once they started this runoff, the Fed had hiked rates 1, 2, 3, 4 times and had 7 total subsequent hikes prior to that, and the runoff overtook the rate hikes. Finally, in October of 18, the Fed hiked, and you started to see mortgage rates start to come down, and this is when talks of a recession before the pandemic hit. And so if you see here, mortgage rates started to come down, and then right here, this is when the Fed said, hey, we're going to slow our runoff and start reinvesting the principals in these mortgage bonds. And then if you see right here in July of 2020, this is when the Fed came out and said, hey, we're going to, number one, start reinvesting in mortgage bonds, but then we're going to go full blown, where everything that gets paid off in our principal reduction, or any bonds that get paid off because of refinancing or selling, we're going to reinvest back into the market, or maturing. So you can see here that when that stopped and the Fed said we're all in, mortgage rates came dramatically down. Let's talk a little bit about recessions now, and what leads to recessions, and some of the indicators that we have here. So if you look over just the last year, this is basically the spread between the 10-year and the 2-year treasury. So typically, like if you look back here, this is basically saying that the 10-year treasury was yielding 1.4% more than the 2-year treasury, which is how it should be. When you go and borrow somebody money for 10 years versus 2 years, you should get a higher rate of return, because you're tying your money up for 10 years. Well, there are some anomalies, and it's a recession indicator, and that's when there's an inverted yield curve. And that basically means that the 2-year treasury actually is yielding more than the 10-year treasury. So if you were to go borrow somebody money for 2 years, you're going to get a higher rate of return than somebody who you borrowed money for 10 years. It's ironic and not the norm. And if you look, we did have an inverted yield curve earlier this year in April of 2022. And if you look here, this is basically over the last 30 or 50 or so years, where it's just basically showcasing that every time there is an inverted yield curve, that a recession follows shortly thereafter. If you look here, this is basically in right before the pandemic. There was a very blip where the yield curve was inverted, and of course we did have a recession shortly thereafter. Shortest recession in our history, but we did have a recession in 2020. The other indicator that is very telling and interesting is the unemployment rate. So anytime the unemployment rate hits a low and starts to tick up, a recession is followed shortly thereafter. And this is basically the unemployment rate over throughout history. And with 100% accuracy, every time we hit a bottom, we get a little bit of a tick up and there's a recession to follow. So if you look here, this was a bottom and a tick up, and then obviously this is the pandemic year, unemployment skyrocketed for the shutdown. And as you can see here, we're approaching a bottom again of the unemployment rate. So the writing's on the wall as far as a recession. It appears there is no soft landing, as the Fed has said that they're trying to achieve. So what does this actually mean though for mortgage rates? And what you can see here is every time there is a recession, mortgage rates have come down. And this is basically the last recessions we've had. In the early 80s, rates went from 16 to 11. In the right shortly thereafter, there was another recession, 18 to 13%. So as you look at this, you can see that mortgage rates have always fared well when during a time of recession, which basically I know a lot of people think we're in one now. From what I understand, they're saying late December to, I'm sorry, late 2022, early 2023 is when the experts say that we think we'll be in a recession. So what does housing do? What does this mean to your buyers for a recession? Buyers hear recession and they think that they should maybe not buy. Well, if you look here, outside of the housing crisis, housing has always fared well, especially right after a recession. This was the housing crisis, which obviously was spawned by housing, and there was a lot of crazy loans going on. You had a pulse, you could get a loan, but after every other recession outside of this, you can see end of recession, housing goes up. During the recessions, housing fares well. The last recession we had, obviously housing has performed very well during and after this. And the one thing I can say is that I do think that there are very short buying opportunities right before a recession, and I think it's something that we should be telling our clients about. I remember in 2019, in November of 2019, everybody said the market was tough, and I know there were people in my neighborhoods. As far as us, it was a buyer's market, and there was a brief time where people got some good deals on houses, and the people who bought in November of 2019 have bought right at the great time. So I think being prepared for the short time that we're in, like now to the next 6 months, is a buying opportunity. And then once it is, oh, we are in a recession and rates come down, you're going to see housing continue to perform even better. So the other thing, obviously, is record low inventory. I don't have to tell you guys about this, but if you look at this is just a graph showing of the peak inventory we've ever had, and during the housing boom, we had 3.7 million homes on the market. When at the time this slide was made, we are currently at 870, but today we're at about 1.16 million in inventory. And I know that the media is going to talk about this, but that's no surprise. We're coming out of the spring market. Today's the first day of summer. There's always a tick up in the spring market. People put their house in the market. They want to sell their home. They want to buy another home so they can get their kids into the new school wherever they're moving. So if you look at a graph, you can see that during the spring market, inventory always goes up. And the other thing I thought that I saw today was pretty interesting was that of the 1.16 million homes that are on this existing home sales index, they don't count. They count all of the ones that are under contract. So they basically were saying that 55% of these 1.16 million are actually under contract or pending. So that means that the actual, if you take basically 45% of 1.16, it's, call it 500,000, give or take, homes that are actually available to the public. And if you look at this, you'll see that we have 14 million more households from when we were at our high. So the 3.7 million homes we had, or 3.5 million in 2007, right before the housing bubble, we have about 3 million fewer homes and 14 million more households. This is the household index. And you can see in 2017 to now, we are much higher. So we really think that this bodes well for housing. I think it's a bright future for housing. I think that as interest rates go up to curb inflation, and as the Fed continues to raise interest rates, and once we do inevitably get into our recession and interest rates start to come down, we're going to continue to, housing is going to continue to perform well. And I think it's a bright future. So we'll go ahead and open up the floor for any questions. And as always, if you guys want a copy of this presentation, just let us know. We can, I know that this can really help when you're talking to buyers to be able to show this stuff to them.
Awesome. Yes. If you have any questions, you could go ahead and put them in the chat, and then Jessica will moderate for us.
Yes, perfect. And while you guys are on the topic of sending out the presentation, if anyone would like a copy of that, you can certainly reach out to John and Caleb at kjg@compmort.com, and we can certainly get you a copy of that. All right, we will jump right into some questions that we have here right now. If you have anything, if you haven't asked a question yet and you have something on your mind, again, make sure to drop that into the chat box that we have here. This is certainly an open discussion, and we want to make sure that we get all of your questions answered, or kind of talk through any thoughts or concerns that you all have while you're listening in today. So first question here, how important is it that us professionals in the industry monitor the possibility of a recession?
Well, I think it's important to be informed. It's very hard to, I mean, I wouldn't say you have to monitor the possibility of a recession. The possibility of a recession is pretty much on the writings on the wall. There's no way in my mind that you can't have your cake and eat it too, just to put it bluntly. Like the Fed can't curb inflation without the economy slowing. That's not a popular thing for the Fed to say, so they don't say that. But I think it is important to remain informed and be able to explain these things to your buyers, just because you really want to position yourself as the expert. So I do think it's important to be informed and be able to show a buyer what has happened, why it's happening, and what has happened in past recessions, so that they're not so fearful. If they go, the media is all about clickbait and doom and gloom. If you watch the media, they'll tell you that there's a big bubble and it's gonna burst, and it's really not, in my mind, it's not malicious, but bad news sells. If they said the housing market was great, nobody would read it. So being able to be armed with facts and being able to see what the market's going on, I think, is extremely important.
And just on that too, I think, like, for your client, it also is just a question for your client, as far as, we're confident the housing market's going to be steady, but it is a question: is their job recession proof? And if someone is in a job that they believe that they may lose their job in a recession market, like, that could be a concern. I mean, that they would want to think about, right? But like John says, there's a lot of hype, a lot of spin. If it bleeds, it leads. They're selling ads. Like, the media is going to definitely scare the heck out of everybody. But our experience and what history has shown is that the housing market's going to be steady, and if they're confident that they're going to be gainfully employed, continuing, they'll be fine.
I think that kind of answers another question we have sitting here of if someone's concerned about the recession, so should they hold off on entering the housing market? But anything else to really add to that besides employment?
Well, no, I think that is and what I would say to anybody who is fearful of the housing market is that it's a long-term investment, and regardless of what the market is doing, you should plan for the worst and hope for the best. And planning for the worst is that if you're gonna, I firmly believe that you should not be buying a home unless you're prepared to hold it for 10 years. And that way, if you tell buyers that, and you can say, hey, you need to prepare to hold it for 10 years. If the market did what it did the last 3 years and you can sell it and you decide you want to move or upgrade or whatever, then great. That's hoping for the best and the best actually occurring. But if preparing for the worst, if the market does turn, well, you planned on holding it for 10 years anyway. And so I think that as long as buyers can understand that it's a long-term investment and that what is the alternative, unless you're living with your parents rent-free, rents are up 14% year over year. Those numbers just came out, and that's including renewals in that number. So even if you were, I've been living here for 10 years and the guy's going to take care of me, still on average 14%. And then I think when they did the average, like if you take just the renewals out of that, renewals are up 8%. So average 14% with renewals, 8% with just if you are renewing. So the alternative isn't much better. And I think that the facts are, I think I heard that nobody likes a higher interest rate. I don't know if you've seen this meme going around. It was that, marry the home and date your interest rate. So I do think that is very some poignant for buyers right now, is to tell them that, hey, you are going to have a 6 month, you could potentially have a 6 month time to buy here, where you're going to get into a house that doesn't have 40 offers in it because of the market slowing, hopefully. And you can refinance the interest rate. Ultimately, it's what payment you're comfortable with. And that's where we can really help you guys, is what is the client comfortable with? If they're comfortable with a $2,500 mortgage payment or housing expense, let's focus on that and say, hey, buyer, this is what a $2,500 mortgage payment is going to be, a $350,000 home. And go look at $350,000 homes. If you see one you like, what you can kind of see is that the clients don't really care about the rate, they care about the payment. So.
Okay. Thanks so much for sharing that, you guys. Let's see, what effect does the increase of interest rates have on cash buyers?
The interest rate, well, I guess you could say that it has no effect on them. They don't need a mortgage. They can go pay cash. But you could say that for a cash buyer, the interest rates, the Fed funds rate going up, would be that they could potentially, as interest rates go up, the question becomes, does it make more sense for them to keep their money invested or be able to go into safer investments? Because we've over the last 30 years seen very low interest rates. But if you look, I'm sure you've seen that back in the 70s and 80s, interest rates were very high. So people with a lot of cash back in those days could sit on the sidelines and go into the bond market, and you got $2 million in retirement funds. Well, you can just put it all in treasuries and call it a day. You're making money off of you don't have to take stock market risks. So I do think that cash buyers could potentially say that they want to get a mortgage even more, but obviously the interest rates on mortgages aren't necessarily attractive either. But I guess the short answer would be that if you're a cash buyer, these rising interest rates really have no effect on you. You're immune to having an interest rate worry because you got cash. You don't got to borrow the money.
All right. Let's see. So I feel like you guys kind of answered this, but I'm still going to bring it up just to make sure if you have anything else to kind of add on this topic. You had recommended, purchasing within the next 6 months by the time we hit December. let's see, would you recommend, you know, that realtors urge their clients to secure mortgages as soon as possible as we reach that December point? I guess anything else to add to that?
I would just say they obviously can't secure a mortgage until they've got a contract and close on a home. So yeah, I mean, I would say that a better way to put it is to be prepared. Get your stuff rolling. Don't be on the sidelines waiting for this magical decrease in pricing and thinking that prices are going to go down 20%. I don't see it happening. I do, however, think that to those that are prepared, meaning they've got a loan application in, they've got a strong pre-approval, they're ready to go, they've even got a fully underwritten loan commitment with us. Yes, I do think that when the opportunity comes, they're going to have to strike, and I'm sure the realtors on the line can attest that usually a lot of times when opportunities come, people aren't prepared. And I do think that it's going to be a very short-lived time to buy. I think that as soon as the recession comes and you start seeing interest rates go down again, you're going to see the housing market start performing really well again, and it's going to be a blip on our radar this next 6 months to a year where people could buy. So I would absolutely say yes, talk to us and get prepared and be ready to pounce if something does come on the market that they like.
A little piggybacking off from that, let's see, in terms of refinancing, would there be a time frame that someone would have to wait if they purchase at any point and then rates drop?
No, now there's a lot of places that will tell you that you have to wait 6 months, but it's not true. You can refinance as soon as the ink dries. So now obviously there are these have kind of gone away, but I've seen recently where prepayment penalties have come back for, like, we're talking non-QM loans, like weird portfolio loans. But for the average buyer that's doing a conventional FHA, VA loan, which is probably 95% of the market, they can refinance the next day. Some places will tell you they got to wait 6 months because if a buyer refinances within 6 months, we lose our commission. So a lot of places will tell you that that you can't refinance for 6 months, but it's not true. You can refinance the next day.
Okay, thanks for sharing that. I guess kind of talking about, you know, on the topic of rates and refinancing and whatnot, anything else that you can share related to kind of battling the concern of higher rates that clients are bringing up? Anything else kind of besides a solution of refinancing? Anything else that you've
Yeah, again, I think that it's all about the payment and what the client's comfortable with, and then really honing in on what is the client's goal, and really saying, hey, client, you're looking for stability, you're looking for not having to worry about rent going up, not having to worry about them not renewing your lease. What payment are you comfortable with? And let's go look at homes that you're comfortable with that payment, regardless of what the rate is. And if you find one that you like, then we can achieve all your goals. And at that point, I think, at least my experience is, once you can get the client off the rate and on their payment, then they don't really care about the rate as much. So I would, again, just really, and then this is where we can help you guys, is let's compare what they pay now. Let's take what they want to pay, what they're comfortable with on a monthly housing expense, and tell them what that would yield, and then let them go out and shop for a home. My experience has been that most clients, you don't know this because you guys don't do what we do, but most clients are typically buying well under what they qualify for. We definitely have the anomalies every once in a while where you're like, wow, you're tight, you're buying a home that's at the max of your budget, but those are the anomalies. Most clients have a lot of room into what they can afford. So if we can pin them down and say, hey, you're comfortable with the $2,500 payment, and then they go look at homes, and then they find out that, well, you know what they actually really like is a $3,000 payment. Sure, the rate's high, but once we can get them out, once you get the foot in the door, they tend to relent and we'll compromise, and then we can have the discussion of like, oh, well, you can refinance or whatever. But again, I would just say really honing in on what they want their payment to be, and what their goals are. Their goal is to buy a home and own something and not rent anymore and provide stability for their family. The interest rate is relevant to those goals being achieved.
And I'll just say too that on that with our clients, what we do as their lender is that we monitor their mortgage after closing as well. And we're going to let them know if rates do drop that they have an opportunity to save money. So if you get them, like John said, like this is the payment they're comfortable with. Well, the good news is down the road, if rates drop, refinances are much cheaper than buying a home. And we can often lower their payment in the future. So if that's what they're comfortable with, our job is to monitor their mortgage and help them get it lower down the road.
Yeah, I do think too, like explaining to clients that they really get to have the best of both worlds. Meaning if a client buys today at 6% and the interest rates go up to 10, well, the client's a genius. He bought at the great time. Everybody else who's buying 6 months, a year down the road at 10% is a sucker. But if the client was wrong and rates go down, they get to refinance. So the client kind of wins no matter what. And as long as their goals are met and they're comfortable with the payment, who cares what the interest rate is?
And and on that too, we had a lot of folks back when rates were below 3% that were saying, well, I'm going to time the market. I'm going to wait for the values of homes to come down. Then I'm going to buy. Well, they've been sitting on the sidelines when they could have gotten a rate at 2.75. And now today we're talking close to like around 6%. So there's no way to time the market as well. And like John says, ultimately it comes down to payment and what is their goals? Like, do they need a place to live? Do they want to have a fixed payment, or do they want to be at the whim of their landlord deciding to raise their rent next year? Once they're comfortable with the payment, what they know is it's fixed for 30 years unless they choose to refinance to lower it.
All right, thanks so much for that discussion, you guys, on that topic. Let's see, does Compass refinance into reverse mortgages?
We could do reverse mortgages, yes.
Yeah, it's typically, yes, you can refinance a reverse mortgage. Short answer, usually reverse mortgages are people who don't have a mortgage, so you're not refinancing, but if you did have, like, let's say a $50,000 mortgage that you paid off and then took a reverse mortgage out on, I guess that would be considered a refinance and a reverse mortgage. And yes, we do.
Cool. Let's see. So, Offer, if you need more clarification on that, just send in another chat there. Let's see. Last question we have sitting here right now. Any idea of how many more times rates are going to hike this year?
Well, I mean, they said. Yeah, I think they're going to go every month, and I think their target was 3%. And
just to clarify though, John, you're talking about the Fed. Like, let's just distinguish what we're talking about here. Not mortgage rates, but the Fed.
Yeah, so the Fed has said that they're going to hike interest rates up to 3%. That was their target, but based on the last time them reneging on that and stating, because they said they were only going to raise 0.5%. And then they came out and raised 0.75%. So I believe that now they're saying that by the end of the year, they're going to have the Fed funds rate all the way up to 3.75. So that would basically be, they're doing it every month. So depending on whether they're doing 0.5% or 0.75% monthly, I know that they were planning on raising the Fed funds rate monthly for, I guess it'd be 6 more months. Now, what you'll see though is we should see, hopefully by the end of the year, them doing this inflation top out. And then once we see that inflation is starting to come down, you're going to see mortgage rates start to follow suit. So hopefully the sooner the better on that.
Was that the last question, Jeff?
Yeah, just double checking. Nothing else came in while we were chatting on that.
I just want to say then, right now we're in this moment where there's a lot of, folks are nervous. We all are, right? There's uncertainty. We're not as busy with handling clients as we were the last couple of years. It was, our phone was ringing. But right now is a huge opportunity for you to really focus on prospecting and grabbing market share. Right now, you're going to see a lot of realtors that were living the high life the last couple of years that are going to possibly be bowing out because they don't have the business they did before. We're seeing this with loan officers. There was loan officers that were riding that refinance wave, and now that that's gone, they're leaving. They're going and getting other jobs. And we see that as a huge opportunity to grab market share. So, you can cry about what's happening right now, or you could actually say, you know what, there is a moment right now for me to grow my business and be in position for when the market turns back that you're going to really blow up. So I think that this is an opportune time right now. John and I love partnering with agents to help grow your business. Like if you're interested in strategizing with us on ways to grow, to turn this downturn in the market into an opportunity for your growth, we would love to help you. So I just can't, there's a huge opportunity on this right now. Anything to add to that, John?
The one thing I would add is just what we've been focusing on is one of our top producers here said this, and I thought it was very poignant, is that your activities should not change with the market. You still got to block and tackle, and the fundamentals still work. And if you stick to your daily activities, 20 contacts a day, regardless of the market's doing, you're going to always do well. Don't lose sight of that. That's what we're doing here. And we'd love to help you out on that type of stuff. Just hit us up if you want to strategize about any of that type of stuff.
Awesome. All right.
Awesome. John and Caleb, thank you both so much.
Thank you, guys.
For sharing your knowledge and expertise, and especially to all of our attendees on the webinar today. Thank you so much for joining us. We'll be sending out a follow-up email along with a link to a recording of the webinar. So if you missed any of the chat, you can certainly catch up there as well. Thanks so much to everyone joining us, and have a great rest of your afternoon.
Bye, everyone. Thank you.
Bye-bye.